Hello and welcome, fellow investors. It's Iggy here from Investing Iguana, and today we're delving into a hot topic in the Singapore financial market, the Singapore Exchange, or SGX. In this insightful video titled SGX's Neutral Rating by Analyst and What It Means for Investors, I'm going to unravel the recent neutral rating SGX received from RHB Invest. We'll explore what this means for SGX, how it affects its market position, and most importantly, the implications it has for you, the savvy investors. From analyzing key data points to understanding the broader economic context, I'll guide you through this pivotal assessment and what it could mean for your investment strategies. So, let's dive in and decode what this neutral stance signals for SGX's future. The Singapore Exchange, commonly known as SGX, has been garnering a lot of attention in the investment world recently. This is largely due to an analysis by Shekhar Jaiswal, an analyst from RHB Invest, who has given SGX a neutral rating. This rating suggests that the stock is expected to perform in line with the return of the market over the next 12 months. The target price for SGX has been revised downwards to 9 Singapore dollars and 60 cents from the previous 10 Singapore dollars and 30 cents. This adjustment indicates a projected downside of 3%, which means the stock's price is expected to decrease by this percentage. You might be wondering what's causing this shift in perspective. The primary reason lies in SGX's operating data for the first half of the fiscal year 2024, which covers the period from July to December 2023. The data fell short of expectations, mainly due to less than impressive securities trading data. Securities trading forms a significant part of SGX's business, so underperformance in this area can have a substantial impact on the overall performance of the company. However, it's not all gloomy. There's a silver lining in the form of derivatives trading, which is on track with estimates. Derivatives trading is another crucial part of SGX's business, and its steady performance can help offset some of the impacts from the underwhelming securities trading data. Singapore's equity market, spearheaded by the Straits Times Index, STI, demonstrated a remarkable resilience and allure despite an initially slow start. In comparison to its ASEAN counterparts, it outshone them in December with a robust 5.4% month-on-month advance. This significant surge was not an isolated incident but was fueled by the active participation of retail investors. The growth was noticeable across various segments of the market. This includes index stocks, which are shares in companies that make up the indices like the STI. These stocks are often considered the bellwethers of the market, and their performance can give investors a good sense of the overall market direction. Real estate investment trusts, REITs, also saw significant growth. REITs are companies that own, operate, or finance income-generating real estate, and they offer investors a way to invest in these properties without having to buy them directly. The growth in this segment suggests that investors are seeing value in the property market. Small to mid-cap stocks, which are shares in companies with a smaller market capitalization, also experienced noticeable growth. These stocks can offer higher growth potential, although they can also be more volatile. Let's delve into the securities data of the Singapore Exchange, also known as SGX. The data for the first half of the fiscal year 2024, 1HFY24, shows some interesting trends. There was a 12% year-on-year decline in the total securities market turnover value and the securities daily average value, SDAV. This means that the total value of securities traded and the average value of securities traded daily both decreased compared to the same period in the previous year. However, it wasn't all a downward trend. In December, there was a slight uptick with a 2% increase in the SDAV. Despite this increase, the overall value for the year was still down by 3%. This suggests that while there was some recovery towards the end of the year, it was not enough to offset the earlier declines. These figures have led to a revision in the forecast for the Securities Daily Average Value, SDAV, for the full fiscal year 2024, FY24F. The new forecast is now 8% lower than the initial estimates. This adjustment reflects the impact of the trends observed in the first half of the year and suggests a more cautious outlook for the rest of the year. The derivatives market, on the other hand, tells a different story for the first half of the fiscal year 2024, 1HFY24. Unlike the securities market, the derivatives market has seen a steady increase in both the volume of derivatives traded and the daily average volume. This means that more derivatives contracts are being bought and sold, and the average number of contracts traded each day is also increasing. Two segments of the derivatives market, in particular, have shown heightened trading activity: commodities and foreign exchange (FX) derivatives. Commodities derivatives are contracts that derive their value from underlying commodities like gold, oil, or wheat. FX derivatives, on the other hand, derive their value from foreign exchange rates. The increased trading activity in these segments suggests that investors are actively trading these types of derivatives. The performance of the derivatives market aligns well with initial estimates, indicating that the market is behaving as expected. This reflects a strong interest from global institutional investors in key equity index futures contracts. These are derivatives contracts that derive their value from an underlying equity index, like the S&P Wink with tongue sticking out 500 or the FTSE 100. Let's break down what these changes mean for the Singapore Exchange, or SGX. Based on the data from the first half of the fiscal year 2024, 1HFY24, RHB Invest, a well-known investment firm, has revised its earnings forecast for SGX for the fiscal years 2024 to 2026, FY24F26F. The new forecast predicts a decrease in earnings by 4% each year. This revision is a result of the performance trends observed in the first half of the year. In addition to the earnings forecast, there's also been a change in SGX's ESG premium. ESG stands for Environmental, Social, and Governance, and it's a measure of a company's commitment to sustainable and ethical practices. The ESG premium has been adjusted downwards, which means that the additional value attributed to SGX for its ESG practices has been reduced. This adjustment has an impact on SGX's target price, which is the price at which analysts believe the stock is fairly valued. Despite these changes, it's important to note that SGX's share price is currently trading at par with its historical average price-to-earnings (PE) ratio. The PE ratio is a valuation ratio that compares a company's current share price to its earnings per share. When a company's share price is trading at par with its historical average PE, it suggests that the market perceives the stock to be fairly valued. This means that despite the downward revisions, the market still views SGX as a sound investment. Let's dive deeper into the recent developments surrounding the Singapore Exchange, SGX, and understand how its recent neutral rating by RHB Invest might impact the SGX stock in 2024. This analysis is brought to you by Iggy, the Investing Iguana, your trusted guide in the world of investing. Starting with the neutral rating overview, the shift from a previous target price of 10 Singapore dollars and 30 cents to a new target price of 9 Singapore dollars and 60 cents represents a subtle yet significant change in market perception towards SGX. This change indicates a projected downside of 3%, suggesting that analysts foresee limited growth potential or significant risks in the near future. But what's the reason behind this cautious stance? The answer lies in SGX's operating data for the first half of the fiscal year 2024, 1HFY24, particularly in the Securities segment. The data was somewhat underwhelming, which is a crucial point to note because robust trading volumes in securities are often a key revenue driver for exchanges like SGX. If the Securities segment underperforms, it could potentially impact SGX's overall financial performance. However, it's not all gloomy. The derivatives segment of SGX seems to be holding steady, showing some resilience amidst the overall operations. This suggests that despite the underperformance in the securities segment, other areas of SGX's operations are still showing promise. This resilience could potentially offset some of the impacts from the underwhelming performance in the securities segment. Let's delve deeper into the market position and economic outlook of the Singapore Exchange, SGX. Despite experiencing some setbacks, Singapore's equities market, led by the Straits Times Index, STI, managed to outperform its ASEAN counterparts in December. This performance signals an underlying strength in the market, demonstrating its resilience amidst challenging conditions. A noteworthy observation is the increased activity among retail investors. Retail investors are individual investors who buy and sell securities for their personal accounts, and their increased activity could be a positive sign for SGX. If this trend of heightened retail investor activity continues, it could potentially lead to increased trading volumes and liquidity in the market, which would be beneficial for SGX. Now, let's turn our attention to SGX's resilience and adaptability. As we look ahead to the second half of the fiscal year 2024, FY24, there's a sense of cautious optimism. The economic growth outlook is improving, and there's anticipation of a moderation in interest rate hikes. These factors could potentially spark renewed interest in Singapore REITs, SREITs, and other securities. If SGX can capitalize on these trends, it could offset some of the current weaknesses in securities trading. This would demonstrate SGX's adaptability and its ability to leverage market trends to its advantage. While the Singapore Exchange, SGX, has shown resilience and adaptability, it's important to note that challenges still remain. The investment landscape is evolving at a rapid pace, with new technologies, shifting market dynamics, and changing investor preferences. To stay competitive in this fast-paced environment, SGX needs to stay ahead of the curve. This means continually innovating and expanding its product offerings to meet the changing needs of investors. The recent neutral rating given by RHB Invest might reflect these broader strategic challenges that SGX faces. It suggests that while SGX has strengths, there are areas where it needs to improve to maintain its market position. For investors, this neutral rating and the subsequent adjustment in the target price imply a more nuanced approach towards SGX stock. SGX might not be the high-flying stock that some investors are seeking, but it could offer steady returns for those who are looking for long-term stability in their investments. The key for investors will be to closely monitor SGX's adaptability in the face of an ever-changing financial landscape. Investors should pay attention to how SGX responds to market changes, innovates its product offerings, and navigates the challenges it faces. This will provide valuable insights into SGX's long-term prospects and help investors make informed decisions. And there you have it, a comprehensive breakdown of SGX's current standing in the market with its recent neutral rating. We've covered everything from the operational data that led to this rating to its potential impact on your investment portfolio. Remember, understanding these market shifts is crucial for making informed investment decisions. If you found this analysis helpful, please show your support by hitting that like button. Don't forget to subscribe to Investing Iguana for more in-depth financial insights and expert investment tips. Have any thoughts or questions about SGX's rating and its future prospects? Drop a comment below. I'd love to hear your perspectives. Stay tuned, stay informed, and most importantly, invest wisely. Until next time, happy investing.